Hello friends, in this lesson we will be discussing about the things that to know before applying for loan. There are 10 things that you need to know before applying for a loan. With redundancy levels rising, thousands of households are having to borrow for the first time. If you have never had a loan before, the good news is that assuming you have a good credit rating, rates have edged downwards in recent weeks. However, you may be totally confused about what to look for, so we have compiled a list of 10 things you need to know before you make an application. First is, you can only borrow some amount with an unsecured loan. There are two types of loan. First is secured loan and second is unsecured loan. Unsecured loans are aimed at people who want to borrow a relatively small amount. They tend to be available for amounts between 1,000 to 25,000. Second, a secured loan is held against your property. Secured loans derive their name from the fact that the debt is held against your property. This means your home is at risk and may be repossessed if you fail to keep up with your monthly repayments. The minimum loan size on a secured loan is usually around 10,000 and you may be able to borrow up to 1 lakh. However, the maximum loan size could be lower. It will depend on how much equity you have in your income. Third, you may not be offered the rate you see advertised. The advertised rates you see on many loan deals are typical rates, which means that the loan provider uses a strategy called risk-based pricing. At least 66% of successful applicants must be offered the typical rate, but a third could be offered a higher rate. Fourth, the best rates are available to those with the best credit scores. The rates on unsecured loans have been getting more competitive in recent weeks, but only those with excellent credit ratings will qualify. Fifth is, the longer the term, the more interest you will pay. The cost of your monthly repayments will obviously depend on the amount you are looking to borrow, but it is also dependent on the period over which you will repay the debt. You can reduce your monthly repayment by opting for a long term. However, this will be more expensive because you will pay more in interest. So, base the term of your loan on the maximum you can afford to pay each month. Sixth is, a credit card may be a better option for short-term lending. If you only need to borrow over very short term like 12 months or less, then you may be better off with a 0% purchase card. By making a purchase on a 0% card, you will have the length of the introductory offer in which to pay back the money you owe without paying any interest. Don't be tempted to keep spending until you have cleared the balance, however, because at the end of the 0% period, you will be charged interest at a much higher typical rate. Seventh, it can cost you to pay back the loan early. Many secured loan lenders charge early redemption penalties. For amounts borrowed of less than 25,000, penalties are restricted to just 2 months worth of interest, but for larger amounts the penalties can be much steeper. 8. There may be other hidden fees. Read the lender's terms and conditions thoroughly before applying for a loan and check for hidden fees. For example, several lenders charge administration or arrangement fees to set up a loan, while others will penalize you for making late payments. Ninth, your repayments may be variable. The rates on unsecured loans tend to be fixed, but many secured loans have variable rates, so your repayments could arise. Make sure you know what you are signing up for, otherwise, you could get a shock if your lender suddenly hikes the rate. 10th, you don't have to buy payment protection insurance when you take out a loan. Payment protection insurance is designed to cover the cost of loan and credit card payments if you are unable to work due to accident, sickness, or unemployment. Many people wrongly assume that it must be bought from the same bank or building society they are borrowing from. It doesn't, nor does it have to be bought at the same time a loan is taken out. You will often get a better deal from a stand-alone provider. So, if you want this protection, make sure you shop around and compare prices and the level of cover before you buy. However, if you are currently out of work, now is probably not the time to purchase payment protection insurance, as you won't be eligible to make a claim. If payment protection insurance is something you are interested in, our payment protection insurance. This was a discussion about the things to know before you applying for a loan. Thank you.